Hello, everyone. This is Erica, and today I want to share with you a very important investment technique known as asset allocation. I think it's probably the most basic and effective risk management technique, so it's very important to understand it. In fact, I think it can be the difference between losing a lot of money in your investment journey and on the other extreme, earning a lot of money. So it's very important, and I like to illustrate it with an example. So what you see here is what I consider a well diversified portfolio with maybe a moderate level of risk for someone that has, say, 10 or more remaining years of high income earning years. And when I say high income earning years, I mean, this is relative as well, as it's related to your high and low earning over the course of your work, your entire work journey. Okay, so in this portfolio, and again, it's just an example, I take the total portfolio value at, let's say, $10,000. Okay, so if this is well diversified, in my opinion, it looks similar to this. 60% of that value, which is $6,000, has been allocated to the purchase of stocks, and not just any stocks, but in the category of S&P 500 index funds. Okay, 10% of that portfolio in bonds, and then a 15% in cash. In this case, two types. Let's say certificates of deposit as well as high interest savings, for a total of 15% cash. And then in the alternative category, I give several examples of alternatives. It could be real estate, it could be gold, crypto, or even the Georgia lottery. All of these would be alternative type investments. For me, a moderate risk portfolio would have up to 10% in alternatives. In this example, 15%, up to 15%. And in this example, there are two alternatives that the portfolio is allocated in. 10% of it in real estate and 5% in gold. Okay, so below this, and I give a pictorial of this so that you can see, the idea is that a moderately risked portfolio would have the majority of the portfolio, in this case, 60%, invested in something that was not too conservative, but on the other extreme, not too aggressive or risky, but somewhere in the middle. And for me, that would be an S&P 500 fund. Okay, so that's the premise of a moderate risk portfolio, is that the grand share of it is in something that's pretty moderate. Okay, now here we give a projection of what the performance of such a portfolio may be this year in 2023. Okay, so I projected here that, let's say, for the S&P 500 funds, let's say we do, as many people are projecting, move into a full recession this year. So let's say that, hey, on the worst case scenario, it loses 20%. Bonds, they don't do as bad as stocks, but they still are down 5%. Now, for the cash, these are investments that they're guaranteed to give you a return. There is no risk at all in them, right? So let's say the certificate of deposit, they returned 8% gain, high interest rate savings, 4% gain. And then in this alternative section, let's say I had gains as well. My real estate investments, they were up 10%, and my gold investment was up 10% as well. So the result of this overall would be a 2023 performance of minus 10%. Okay, now what the asset allocation does is it allows us to not have, as severe of a loss had we not diversified the portfolio. So for example, even though I had the largest loss, 20% loss in the lion's share of the portfolio, let's say I would have had all of the investment in the S&P 500 fund. If that was the case, then my loss would have been 20%. By diversifying in other investment avenues or investment categories, we limit the loss. Instead of 20%, which would not be well diversified, we had a loss of half of that, so minus 10%. So this gives an example of the power of asset allocation. It's very important for you to make sure that your portfolio is diversified in a way that you don't have all your eggs in one basket, but at the same time, you have really good earning potential in that the lion's share of your portfolio is in line with your risk level. In this case, this is intended to be a moderate risk level, so we have most of our investment here. But what we hedge it with other investments so that we could reduce the loss should it happen. Okay, so that's the first example here. Now, the next example that I want to show is where I have the same portfolio. So I think it's still well diversified. I believe that this portfolio, in my opinion, is still a moderate risk level portfolio. But the difference is, I think that what I have added is some high risk, high reward investments. So this is where I want to illustrate also the power of asset allocation. If we utilize proper asset allocation for high risk, high reward investments, we can greatly increase the potential for the overall performance of the portfolio. So this example illustrates this. Same portfolio, only difference is I've added the assets in red. So in the category of stock, for an example, I took the 60% and I took 9 of that percent and I put it in individual stocks, 7% of it in individual stocks. So if this is a portfolio of $10,000, what that really means is that I am risking only 700 of it to this higher risk category of investment. And then I also, because I'm in day trading school right now, I took 2% of that allocation that I have for stocks and I put it into swing trading and day trading, which means only 200, I'm willing to risk 200 of this total portfolio in a high risk, meaning that there's a high potential that I could lose it all, but high reward, meaning that there's a high risk, there's a high reward that I could get from it if I'm successful in it. Okay, and I did a similar thing in the alternatives. In the alternatives section, I had a total of 15%. I took 1% of the total portfolio from gold and into crypto. What does that mean? That means of this $10,000 portfolio, I'm willing to risk $100 in a high risk asset class. And I do this because I'm looking for the high return that it might be able to bring. Okay, it has potential to bring higher returns than my other investments, but I'm willing to take a little risk. Okay, so I give a potential, performance projection for this as well. Okay, so let's say in the case of individual stocks, I use, and we won't talk about it right now, but I use some other risk management techniques to ensure that my individual stock investment, it never does worse than the S&P 500. In other words, if it started doing worse than this, I get out of the investments. I'm not willing to lose any more than what I will lose in the S&P 500. right? So I just carefully monitor this to make sure that the loss is not um, worse than S&P. Now, it could be great if it goes. My thought is that it can be greater, which is why I take this risk. But I hedge it against other techniques to make sure it's never worse. So in this projection, let's say that the worst happened, okay, and that, you know, we're in a recession, so the S&P 500 is minus 20%. And let's say that individual stocks that I had, they were performing very poorly. So I end up getting out of them in order to make sure that I didn't get a performance that's worse than the S&P 500. So in this case, there's really not a risk at all because I hedge it other ways, right? In other words, if I wouldn't have done the individual stock investing, I would have put it in the S&P 500. And so it's kind of like a wash, okay? But for the day trading and the crypto, let's say I'm willing to risk it all. So I'm really willing to risk the $200 that I put in day trading and swing trading. I'm willing to lose all $200 of this. And the same thing for crypto. If it goes to zero, I'm okay. In other words, I'm willing to risk $300 in this $10,000 portfolio, which would be 3%. I'm willing to risk 3% in order to potentially get return of what I think could be up to 5x, 5 times this. I believe if I'm a good student and I'm able to execute everything that I've learned in day trading school, I should be able to take this $200 and turn it into $1,000. And the same thing for crypto. I'm expecting that this investment could be a 5x investment. Okay. Let's say that I'm right and I'm able, and that's exactly what happened. Okay. So my swing trading allocation, it goes from $200 to $1,000, a 5x. Same thing for crypto. My $100 turns into 500. So here, between those two high risk investments, I got that high return that I was convinced that I can get. I was able to get it. Okay. So that means that my $300 investment turned into a $1,500 gain, right? So what we say is that that's like a 3% risk, 3% of this portfolio. I took a 3% risk of loss for a 12% gain. Okay. So this now gives you the power of, you know, what proper, you know, asset allocation can do for you as it is related to high risk investments. I took just a 3% risk, a $300 risk against this portfolio. And look what happened to my overall performance as a result of that. My overall performance of this portfolio, it went from minus 10% to an overall performance of plus 2%, which is a 12% swing, right? So essentially, I risked 3% for the potential of getting 12. And in this case, I got that 12%, and he's essentially that, you know, that basically allowed me to overcome all the losses that were in my overall portfolio. Okay. So this is the power of, again, asset allocation. In other words, it says that it allows you, if you properly allocate the amount of the risk based on how risky the asset or the investment class is, you can minimize the amount of the impact in terms of loss. In this case, it was, you know, I'm taking a 3% risk, $300. But you also get exposure to the other part of this, the high return potential, right? So yeah, that's the lesson here on asset allocation. It's a very powerful tool. It's important for every investor to understand this because it is, as I noted, I believe that it is the most basic, not only the most basic in terms of the ease in which you can do it, but it's also the most effective risk management technique that we have in our investment journey. All right. Thank you, everyone.